Okay, so on to ratio analysis. Why do you need to use ratios? Now, you know, a ratio is one figure divided by another, right? What you did in grade 2, division, right? So, for example, you can divide your gross profit by your sales and you get a certain ratio. Now, why are ratios important? Why do you need ratios? Why can't you work with absolute numbers? Why can't you, for example, work with the total gross profit of an organization? Why can't you do that? Why do you need to look at ratios? Well, the first thing is now ratios. Let's say you're looking at a big organization. Let's say you're talking about John Keel's. Right? John Keel's may be a 10 billion rupee profit against a smaller company, a very small startup, which is doing a 1 million profit for a year. Now, if you look at absolute numbers, which one do you think looks better? Is it John Keel's with a 10 billion, a huge profit, or the new startup which is going at 1 rupee profit? Right? So which one is better? If you go only by absolute numbers, John Keel's looks fantastic, right? But if you're going by still going by absolute numbers, if you're making a 1 million rupee profit and you're comparing it against John Keel's 10 billion rupees, you're nowhere, isn't it? So if you turn down the 1 million rupee profit, you might end up turning down a company like Amazon.com, a new startup. Right? Well, Amazon is not a new startup, but imagine the time that it started, it would have probably made losses even, then made smaller profits, right? And then it grew gradually. And today it's Jeff Bezos has become the richest person in the world, right? So it's very difficult for you all to compare numbers in absolute terms. So that's why you need ratios. Okay, so it helps compare. It removes the distortion of size. But sometimes size matters, but not always. Right? So it makes things more comparable. Using ratios will make things more comparable. Also, now in addition to making things comparable, look at something like this. John Keel's, let's say, is making a 10 billion rupee profit on a capital base of, let's say, 100 billion. Right? So that's 10% return on equity. Whereas a startup is making 1 million rupee profit on capital of, let's say, 50,000. Right? So return on equity is 200% or whatever, isn't it? So if you look at absolute numbers alone, you might not be guided properly. Right? You might not be able to make informed decisions. Now, if you're looking at two other companies in similar industries, I would say John Keel's and Aitken Spence. If you look at John Keel's and Aitken Spence, John Keel's is huge, much, much bigger than Aitken Spence. So if that is the case, how do you compare? Right? So that's why you need ratios, because it facilitates comparisons. It removes the distortion of size. So the ratios that you can use, you have all of these types. You have liquidity ratios. Right? Liquidity ratios measure the firm's ability to meet current obligations. Now, we discussed last week that liquidity is as important as profitability. Right? You might be profitable without liquidity. Look at Barings Bank, for example. Barings Bank, remember what we discussed the first week? If you all can recall, the trader that was working at Barings Bank that caused the spectacular collapse was Nick Leeson. Now, Barings Bank was making huge profits, right? Massive profits, but they had no liquidity, which is why they had to wind up. Right? Remember, if you could recall what we discussed 2 weeks back. Now, profitability is there, but they had no liquidity, so they had to wind up. Right? So that's why sometimes liquidity is more important than profitability. You might survive if you don't have profits, but without liquidity, it's not possible. It's almost impossible. Then leverage. Now, what do you mean by leverage? Leverage is the ability. Remember last week we did leverage buyout. That's where a company is bought without using own cash, but using borrowed funds, right? Like SoftLogic acquiring Odell, or like Haley's acquiring Singer, right? So leverage ratios show the proportion of debt and equity in the financing a firm's assets. So equity and debt, two different concepts. Now, equity is what you own, but your own capital, what you have pumped into the business, whereas debt is your borrowed funds. So you're comparing your debt against your equity. Now, how does that work out? How can you get an idea using debt and equity ratios? Simplest example I can quote is, if you are investing 100 rupees of your own money at a rate of, let's say, 10%, right? Then you get a return of 10. So your return in percentage terms is also 10%. That's because you get a return on 10 on an investment of 100. Now, if you're not happy with the return of 10, what you can do is you can borrow 1,000, let's say at the rate of 8%. So you borrow 1,000 and reinvested at 10%. You get 1,100. You get $100 plus the previous 10, 110, right? Then you repay your debt. You're left with 100. Yeah. And if you're borrowing at 8%, then your borrowing cost is 80. So the 110 minus 80 is 30. You're left with a profit of 30 on your original investment of 100. So your return increases to 30%. Now, effectively, what it has done, leverage has done, is it has increased your return from 10% to 30%, right? 3 times, you're making 3 times the profit. So that's what leverage can do. It can magnify your returns. But the downside is, now, if your borrowing cost by any chance was 12% and you're getting a return of 10, right, you will end up paying interest of 120. And your net return is still at 110. So you're ending up with a loss of 10. Then your return will be negative 10%. Right? So leverage can either make you richer or it can make you very poor, depending on how you are using your funds. If your return is more than the cost, then your returns are magnified. But if your return is less, you will lose a lot of money. And so leverage is good if the return is more than the cost. That's how leverage works. So the point is, the higher your leverage is, the higher risk you're taking. Right? Because by any chance, now in some cases, it's not possible to predict what your return is going to be. Like in the case of equity. And if it's in the case of bonds, then of course, yes, your return is fixed. But in the case of equity, your return is not fixed. So if you're borrowing and investing in equity, then your return is not fixed. So by any chance, if your return is not enough to cover the cost, and if you're highly leveraged, you're highly levered, you will lose a lot of money. Right? So that is the risk. So higher the leverage, higher the risk. Right? So that's how this works. Then activity ratios. Right? They reflect the firm's efficiency in utilizing assets. Now, how efficient is a firm in utilizing a certain asset? Right? The same asset with 2 different firms can result in 2 different efficiency levels, depending on so many factors, like the knowledge of staff, the previous experience, expertise, the learning curve, the market position, right? So many factors can contribute. So how efficient are you in using resources? The profitability ratios, it's something that all investors will look at. The first thing an investor will look at is the profitability. Right? If a company is not profitable, they might not invest. There is no point investing in companies that are making losses, or companies that are not likely to make losses either. Right? Because if some company is not making profits, but if there is lots of potential, it can still attract lots of investors. Whereas if a company is making good profits, but the potential is dying down, like take, for example, a company like Kodak, right? Remember? Now, 20 years ago, every town there was, I remember the Kodak sign, there were shops in every town, every city, every corner, there were shops with the Kodak sign. How many Kodak signs do you see on the street today? Not a single, right? Everything got wiped out. So Kodak was a pioneer in the market in film rolls. They were instrumental in bringing up digital technology, digital cameras also, but it didn't work out, didn't last. The business model was not viable. Right? So the profitability was high, but the business potential was not that great because competition was taking over. Then, if you all can also recall, 10 years ago, right? How many of you were using Nokia? Perhaps all of us were using Nokia 10 years ago. But today, how many of us are using Nokia? Not a single. Right? Very few, maybe 1 or 2%. Right? So the irony is Nokia was the market leader and its profitability was so high, but it was not very nimble, not as flexible as SoftLogic, right? No, not SoftLogic, like Samsung, sorry. And look what Samsung has done today. It's Samsung and Apple that's leading the way. Okay, so you can go from the market leader to absolutely nowhere. Right? Profitability ratios measure overall performance and effectiveness of the firm. Right, so that's what the profitability ratio can measure. Now, these ratios you need to remember, can get tested at the exam. So current ratio is you divide your current assets by current liabilities. Current assets divided by current liabilities give you the current ratio. Quick ratio is current assets minus stocks divided by current liabilities. Now, current liabilities, current assets means all the assets or liabilities that are there for the short term, like maybe cash, current asset. Then your inventory, current assets, your debtors, current assets. Current liabilities are things like your overdraft or your short-term borrowings, current liabilities. Usually assets or liabilities that mature within a period of 1 year. Now, why you are removing stocks from the quick ratio is so that you have, because stocks really don't add any value, no? Carrying stocks is actually a burden, right? So if you remove your stock component, how does it look at? How does your quick ratio or your current ratio look like if you remove the element of stocks? Right? You can inflate your current ratio if you have lots of stocks. Now, in some companies, the balance sheet can be boosted artificially by inflating the value of stocks, right? Because stock valuation is very tricky. There are complicated methods of valuing stock. And there is no right or wrong way of doing it. So it's easy to manipulate. Right? So the best thing is to eliminate stocks from your current asset levels and then see where you stand. Or then you can analyze where your customer is. As a banker, you need to know your customer's financial position. You will be in a better wicket, right? If you remove the element of stocks. Otherwise, if you include stocks, it might be a little bit of a tricky wicket to bet on. Right? Okay. Now, current ratio, if you look at the current ratio, current assets divided by current liabilities, ideally, the benchmark is a level of around 2. The ratio should be around 2 or slightly less, right? Between 1 and 2 ideally. Now, if you're less than 1, that means you have less current assets than current liabilities, if the current ratio is less than 1. If the current ratio is 1, that means your current assets are equal to current liabilities. If it's 2, that means you have 2 times current assets than current liabilities. Right, so what's the importance of this? Now, if you are a company that is very determined to meet short-term obligations so that you don't run into any operational difficulties, then you need to have healthy levels of the current ratio. Right? If the current ratio is too high, what happens is now current ratio is current assets. No, if the ratio is too high, that means you maintain lots of current assets, which is not value adding. Right? You have excess amounts of current assets. Your liquidity levels, you're maintaining high amounts of maybe cash. Right? So if you're maintaining high amounts of cash, your returns are less. Isn't it? Yes. Cash gets a return of 0. So the higher amount of cash you have, the lower your return. So likewise, the current assets usually produce lower returns. You're not going to benefit. Right? So you have excess amounts of current assets, your return is likely to be less. It's going to have pressure on your bottom line, right? Bottom line pressure. Now that's not good. You might have top line, but without bottom line, you are not going to survive the long run. Yeah? So it's not good to have excessive amounts of current assets, right? That is not going to work in the long run. But if your current assets are too low, then how on earth are you going to cater to the current liabilities? That's what's going to be tough. So you have to strike a balance somewhere in between. That's why current ratio is important, right? So you remove the distortion that is caused by stocks through quick ratio. Now, if you take a company like Toyota, which maintains zero inventory, zero stock, the amount of stocks they maintain is zero now, then by coincidence, current ratio is equal to quick ratio. Now, quick ratio is also called the acid test, right? Because Toyota is practicing this concept called just in time. That means they only get the stock only when they need. If there is no need, nothing is maintained as stocks. And so the advantage of that is you don't have stocks. There is no holding cost, because for you to buy stocks, you have to pay to your suppliers. Then you have to store it in inventory. So there is no inventory space that is required. There is no storage cost. There are no overheads, no staff to manage the inventory. So much of cost saving that comes with zero inventory, just in time. Right? So Toyota, remember, practices zero inventory or just in time inventory management, which is a fantastic concept. Right? Now Toyota never runs out of stock. No, they get everything right at the time they need. Yeah, holding time is almost zero, so cost is almost zero in terms of managing inventory. Right. So current ratio and quick ratio. Right. Now, if you remove the element of stocks, you know exactly how much of current assets you have, and these are easier to value. Now, the amount of debtors, for example, easy to value. Now, how much another person owns a company, and so there'll be agreements and all that. So you know exactly how much the amount of debtors are. Also, cash. All these kind of current assets are easy to monitor, right? Whereas stocks are very difficult. So ideally, your current ratio, your quick ratio or your acid test should be around 1 or slightly below even, right? 1 is the ideal level of current or quick ratio. That's why you need liquidity ratios. Okay. So if you are short of liquidity, your ratios, these two ratios, the current ratio as well as the acid test or the quick ratio will be low. Then industry. Now that's the important thing. You need to compare it against an industry, right? So if you're operating, let's say in the garment sector, you have to compare with other garment factories. Right? So you take Brandix, a company like Brandix, they will compare themselves against MAS or Haley's MGT. Maybe it can spend garments. And so similar sectors will have to be compared. Now, a company like Brandix may not compare themselves against a hotel, right? They might not compare against Keel's hotels. That's not how it works. You have to compare against the industry. So you look at the industry. If the current ratio in the industry across the industry is 3, and your current ratio is 2, and you're managing well, that means you're more efficient than the industry. But if a current ratio is 5, whereas the industry is 2, that means you're doing something pretty bad. You're not as efficient as the industry, right? And it might get reflected in the bottom line also. So likewise, the quick ratio, you have to compare against industry. All the ratios you need to compare against the industry. So if you take a banking sector ratio, like for example, your NIMs, right? NIM of, let's say, bank A is 10%, and that doesn't make any sense, no? Bank A has a NIM of 10%. Now, as an investor, how on earth can you fit it into where you want it to? Right? It doesn't give you an idea. So what you need to know is bank A is 10%, bank B is 15%, bank C is 5%. Right now, it's easier for you to compare. That is what you need to know as an investor. Where do you stand against the industry? Where does the company stand against the industry, right? So that's the most important thing. If you're finance guys, you need to compare yourself with the industry. And before you make investment decisions, you also have to compare your investment option against the industry, right? That's how you make decisions. Otherwise, you can't make decisions on a standalone basis. Things do not work like that. Right, leverage, I explained earlier, it's the ratio. Now, one ratio you can look at is debt to equity. It's the amount of debt divided by the amount of equity. The amount of borrowed funds divided by your own funds. Now, higher the ratio, let's say there are two companies in the same industry. One has a debt to equity ratio of 50%, the other one has a debt to equity ratio of 75%, right? Purely on risk perspective, the company with 75% debt to equity is at a higher risk. That is what has happened to Sri Lanka also. Our debt to GDP, remember, very high. It's around 80% debt to GDP. That's what debt can do to you. It can either make you or break you. So debt to equity, very important concept. So that's debt to equity. Now, as bankers, you all might be reluctant to lend to companies with high gearing ratios, right? But as a very prudent banker, you need to look at what a company's gearing is against industry peers, right? So you have to compare across an industry, not across industries, right? So debt to equity, very important concept. Now, generally, if the market or the economy is growing, debt to equity, the higher the debt to equity, the better. But if an economy is contracting, this might be very risky. Gearing, the amount of long-term liabilities divided by the equity plus reserves plus all your long-term liabilities, right? So the amount of your long-term debt as a ratio of your long-term funds, whatever the long-term funds that are available to you, maybe in the form of equity, reserves, or long-term liabilities. Again, higher the ratio, higher the risk. Right? So again, it might work when the economy is growing, but when the economy is contracting, it is not really good. Right? So remember, very important ratios, leverage ratios. Activity or operational ratios, how efficient are you in managing your maybe your debtors, right, your inventory or your suppliers. Now, when in terms of debtors and inventory, right, the shorter the better, which means you have to get your debtors to settle faster, or your stock should last only for a short period of time. Right? If you're, for example, if you're giving extended credit to your customers, right, if you're giving 2 years credit, but if you're collecting your funds on the other hand in 1 month, collecting 1 month is always in your favor because you get funds faster, and the funds that you receive can be used to settle your short-term obligations or whatever the obligations that you may have. But if you are taking a long time horizon to collect your collect from debtors, it increases on one side, it increases the liquidity constraints on you. Right? Your liquidity is going to run short. You won't have sufficient liquidity, so that is going to be an issue. On the other hand, now if you collect faster from your debtors, you can use it. You can use the funds for further investments, right? Or to increase your sales further. So it's important that you maintain low levels of debtors prepayment days or debtors turnover and stock turnover days, right? Or your days of inventory turnover. So remember, in case of assets, it's always good to convert or give shorter time periods for your asset turnover. That means asset turnover means, let's say, for example, you're buying goods on credit from a supplier. So those goods that you bought will be maintained in your inventory now. That you'll hold them in inventory for some time. and after a certain period of time, it will be sold to a customer, right? Maybe the customer might buy it on credit, and he will take a few days to settle. Now, once the customer settles, you will use the funds to pay your creditors, right? So that is the cycle, right? It's called the cash conversion cycle. How long you will take to convert a purchase into a cash sale. Cash conversion cycle. Shorter the cycle, the better, because it means you're receiving or collecting cash faster. For the cycle to be shorter, your asset side, that means your debtors and your stocks, turnover has to be shorter, and the time period you take to pay your creditors has to be long, right? So you have to get the collections fast, and you have to pay as far apart as possible. So that way you will hold on to cash for longer. The cash that you hold on, you will be able to invest in other funds and earn further returns. That is in theory, in practice, right? But there are further items to it. We will discuss later on. This is how you calculate debtors turnover period, your average debtors divided by sales into 365. Right? We will do calculations later. So average debtors divided by sales into 365. Right? Stock turnover period is your average stocks divided by cost of goods sold into 365. Creditors turnover period, average creditors divided by cost of goods sold into 365. So remember, stock turnover and creditors turnover are both based on cost of goods sold. Right? So cash conversion cycle is the debtors turnover plus stock turnover minus creditors turnover. So the two asset components you need to add minus the liability side. It's called cash conversion cycle. So remember, cash conversion cycle should be ideally as low as possible. Profitability ratios, your gross profit or net profit ratios, margins, they're called margins. That means for every sale, how much of profit are you generating in terms of gross profit or net profit? Right, so if you make a sale of 100, then if you are making a gross profit of 10 and a net profit of 5, that means for every sale that you generate, you make a gross profit of 10. Now, this gross profit that you make will cover your other expenses like your admin cost, right? And the financing cost, overheads, all those expenses will be covered. So it's gross profit or your net profit divided by the amount of sales into 100. That gives you the margins, right? Profitability margins. Again, you have to compare it against the industry. Right? Now, the gross profit is, remember, it is sales minus cost of sales, right? So cost of sales is the element that you need to manipulate. You need to have control over. Because in some cases, your selling price might be fixed. Unless you're selling premium brands like Mercedes-Benz or Audis, a Porsche, right? You're selling premium products or maybe Louis Vuittons, right? Montblancs, Rolex. Then your price is premium, no? Right? In those kind of luxury goods, you can increase the price to levels that you want. Right? Higher the price, higher the demand for luxury goods. But for most products, like consumer goods, or staples, the price levels might not be all that elastic. If you increase the price by a certain percentage, the demand for the product might fall drastically. And so maybe due to competition or regulations, or even customers might not see it as essentials. Now, best example is during the lockdown, most of the products that we used were not required, right? We were all at home, no one is going out. So no one wanted anything that is beyond basic needs. We only wanted food, nothing else, hardly anything else, right? How many of you bought clothes during the lockdown? No one. All the shops were closed, and shops were closed, and the other thing is you didn't buy clothes not because the shops were closed. Shops closed because no one was coming to buy anything. isn't it? So it's during a time of crisis, everyone will go only for basic needs. Right? Basic needs are the crucial thing during a crisis. You will not look beyond basic needs if there is a crisis. Okay. Right. So the point is, now when it comes to sales, selling price, the price might not always be flexible. So if you don't have flexibility in price, and let's say you can sell a certain item only at 100 rupees, you can't sell at any other higher price. You might be able to bring down the price. If there are no negative consequences, yes, you might be able to bring down the price. But if you're comparing against the industry and your gross profit margin is 10%, the industry's gross profit margin is 20%, that means you're doing something radically wrong. Something is really wrong. So you need to do something about it. Right? If that is the case, only thing you probably can do is to try and reduce cost of sales. Now, how do you reduce cost of sales? What are the elements in cost of sales? It is yes, the opening balance of stocks plus purchases minus the closing balance. Right? Now, that is the key. You have to manipulate within that. Right? So the cost of sales is what is within your control. Unless it is fixed, the best way to control is probably to maintain zero inventory. So that's why inventory management is so important. You can do, in fact, a PhD on inventory management. It is crucial and make or break a company. Right? So remember, gross profit is about cost of sales. And sales minus cost of sales gives you the gross profit. Right? So every element of gross profit you generate, how much of sales do you need? How much of sales do you need to generate 1 unit of gross profit? Right? So what gross profit margin measures is for every unit of sale, how much of gross profit are you generating? Then the net profit, right? That's where all your overheads come in and your finance cost and all that. Now, when the overheads and finance cost and all that is added, plus your taxes, right? That is where you can cut down on cost. Right? So the real efficiency usually comes in net profit margins. Because if you can keep your overhead costs low, then you're going to ace your business. You're going to do well. What you can do is to try and eliminate or reduce unnecessary layers which are not value adding, but a burden on the company. And that's how you reduce the cost of sales. Reduce, not the cost of sales, other administration and all that cost, right? So if you can reduce this cost, it will increase your net profits. Net profit is going to increase. Okay, then the ratio tells for every unit of sale you generate, how much of net profit are you making? So if you sell 1 unit and 1 rupee, right? If your sale is 1 rupee, and if your net profit is 5, your gross profit is 10. That means in between you have, in between gross profit and net profit, that is your fat. Your fat layer is 5%. You have a 5% fat layer. If you can bring the fat layer down, if you can bring it to 3%, your gross profit, your net gross profit will be 10. And if you can reduce the fat layer to 3% instead of 5, your net profit will increase to 8. Right? So it's how well you can reduce fat or the slack. Having said that, it's very important that you keep doing your value additions, right? You can't cut down sometimes on marketing expenses, right? Very difficult. So that's why you need gross profit or net profit margins. Then asset turnover. It's turnover divided by assets. Right, so turnover is the amount of sales you generate divided by assets. So how are your assets contributing towards turnover? For every asset, because assets are investments, no? Every investment that you have made, how much of sales are you generating? Right, for 1 unit of asset, how many units of sales are you generating? So if your asset turnover is 10, that means for every rupee that you have invested, you are getting a sales proceeds of 10. So higher the sales or higher the top line, the better. Then return on capital employed. Right, return on capital employed, profit before interest and tax divided by the capital. Okay. So it can be split, which is called DuPont analysis. DuPont analysis. Now, remember, this is total capital, which includes debt, right? Which includes debt. So it's you can break down the profit before interest and tax as profit before interest and tax divided by sales, sales divided by assets, assets divided by capital, right? So profit before interest and tax, you can actually use profit after tax. That's a better way of doing it. It can be profit after tax divided by sales, so sales divided by assets, assets divided by capital. Profit after sales, profit after tax divided by sales is called profit margin into asset turnover into leverage. That's how we calculate your return on capital employed. Now this expanded version is called DuPont analysis. Okay, so remember that. Then your return on equity, how much of return are you generating for your equity holders, right? Your equity holders are entitled to the profit after tax. Technically, they're entitled to that. That is what they are left with. So how much of profit are you generating for every rupee that has been invested? That's what you measure by return on equity. Then investment ratios. First one is the PE multiple. Very important ratio. PE ratios. Now, PE ratios these days in the market, the stock market is very low. Sri Lanka is on fire sale. In fact, markets are recovering. Right? So some time back, just before COVID, the market crashed. The index collapsed by about 30%, as much as 30%. And PE ratios or multiples in Sri Lanka have come to all-time low levels. Right? So price earning ratio is the market price divided by earnings per share. Now, earnings per share is how much of profits you generate for a share. Profit after tax divided by the number of shares will give you earnings per share. Right? You can have trailing PE as well as a leading PE. Trailing PE means for the last 12 months, you will have earned a certain earnings per share component. That's called trailing PE, the last 12 months or the previous 12 months, right? So you take the share price with the current market price divided by trailing PE, previous 12 months earnings per share. Then leading PE ratio is your forecasted earnings per share. You have to use your forecasted earnings per share. So it's the current market price divided by the forecast for your earnings per share. Okay, so that's how this works. Now, if you look at this example, it says consumer product has a trailing PE of 27.5, while the median peer group is having a PE of 33.25. Assuming that there are no differences in fundamentals among the peer firms and consumer products, the firm is, what do you think? Can you take 2 minutes or 1 minute? Figure out the answer? Right, so let's go through the question again. Consumer products has a trailing PE of 27.52, right? Now, trailing PE means the current market price divided by the PE, the earnings per share based on the last 12 months. That means already published profit after tax divided by the number of shares, earnings per share trailing. While the median peer group had a PE of 33.25. So the peer group 33.25, they are at 27.52. Right? The peer group, that means the industry is at 33. These guys are below the industry. That means they're not, there's something wrong. There are no fundamental differences among peer firms and right, no fundamental differences with peers, which means if there are no fundamental differences, that means consumer products is probably as efficient as the market. And so there is no reason for consumer products to remain at 27.5 fundamental. It has to go up to 33.25. Right? If there's no fundamental difference, that means they are as efficient as market. So fundamentally, nothing is wrong with consumer products. Right? That means there can be two things now. Now you're talking about the P ratio, right? That means the current market price divided by, it says specifically, look at it, trailing PE. That means the earnings per share for the last 12 months. The last 12 months earnings per share. Now the last 12 months earnings per share will not change. No, you can't go back and change your financials, right? So the last 12 months is not going to change because these are not forecasted, these are trailing. Okay, so last 12 months PE is not going to change. What will change is, what can only change is the forecasted PE, earnings per share, if at all. But here you are given the trailing PE. Right, so earnings per share will not change. Price earnings is now at 27.5, industry 33.25. So if there is nothing wrong in the company, what should happen is consumer products should re-rate to industry. So it's now at 27.52. It has to re-rate to 33.25. And earnings per share is not going to change. Like, two things should happen for it to increase, for 27.52 to increase to 33.25. Either the price should go up or earnings per share should come down. Right? Either way, PE will increase. Now, what do you think is likely to happen? Earnings per share we discussed is not going to change because it's trailing PE. The only thing that can happen is the price should increase. Right? Isn't it? Because earnings per share will not change because you are talking about the trailing PE. The only thing that can happen is the price of consumer products should increase. It should increase to such a level that consumer products will end up with a PE ratio of 33.25 at industry levels. So for the price to increase, if the price is likely to increase, it is currently undervalued. Right? Undervalued, so you need to purchase consumer products. You have to purchase it now. Okay, right, so next investment ratio is dividend cover. Now, if you are an investor, you will look at two things. You will look at dividends as well as capital gains. Right, so dividends is how much the company pays to ordinary shareholders per share. Right, out of the earnings, the dividends will be declared usually out of earnings. So earnings minus dividends is what the company retains. That's called the retention rate. That means earnings minus dividends divided by the earnings gives you the retention rate. Okay. Now dividend yield is your dividend divided by the current market price. That's called dividend yield. That means if you invest in a company which is cum dividends, Sampath Bank 2 weeks ago had dividends 11.75 rupees per share and the share was trading at 112. So that's a dividend yield of 11.75 divided by 112 of around 12%, of around 10%. Sampath Bank was going around those levels, right? Dividend yield 10%. Fantastic. So that's dividend yield. Now, what is dividend cover? It is earnings per share divided by dividends per share. Right? That means out of earnings, how much of dividends are being declared. Right? Earnings per share divided by dividends per share. That means your earnings, how many times of your earnings are being declared as dividends, right? It means if you continue to earn this amount of earnings, how many times can you sustain it? Okay, so it's earnings. That means if you're making earnings per share of 10 rupees and declaring dividends of 2, your dividend cover is 5 times. That means the current earnings will be sufficient to cover 5 years of dividends. And that's what it means, dividend cover. Right, so you can use ratios in this manner. Now, look at the first ratio, current ratio, financial year 2004 and 2003. Right, from 2003 to 2004, the current ratio has increased, whereas the average industry is going at 1.9. Right, so your company is now above industry average, and it is also increasing. Yeah, so you have lots of current assets with you. Then the quick ratio is 1.8 going up to 2.18. Again, industry is very low. So you are maintaining excess amounts of current assets, right? Working capital ratio, that means your current assets minus current liabilities. It has increased from 63 to 90. Inventory turnover ratio, 10.47 down from 10.56, industry's 10.6. Accounts receivable turnover ratio, 9.78 down to 9.76. Now, inventory turnover ratio means you're holding on to inventory for longer, right? That means inventory turnover ratio means for a given year, how many times your inventory is being rotated, right? So it's like the number of times you're purchasing inventory. 10 times, it used to be 10.56, but now it's down to 10.47, whereas the industry is 10.6, right? So you're not as efficient as the industry. Accounts receivable turnover ratio, how many times you're collecting from your debtors for a year. Now it's down from 9.78 to 9.76, slightly down. Debt to equity ratio has increased. That means your amount of leverage is increasing. Times interest earned ratio. That means well, interest earned, your profit divided by the interest earned. It's going up. That is good. Your return on assets are also increasing. That's not bad. And you're above industry average. So that's pretty good, right? Because in spite of maintaining high current ratios, your return on assets is increasing. Return on equity is also good. Industry is 10, you're doing pretty well. Gross profit percentage, again, below industry, not good. So your gross profit is below industry, right? But your return on equity is above industry. Then earnings per share gone up, pretty good. Price earnings ratio, your PE ratio is down. Industry is 19.8. Dividends you have not declared. Right, for homework, I would say you can try as many ratios as possible using, well, not only these figures, whatever the figures that you have. Working capital management. Sorry about that, guys. Okay, working capital is your current assets minus current liabilities, right? Working capital is the capital of a business which is used in its day-to-day operations. Simply the current assets used in operations, right? So working capital means your current assets, the net current assets, the net short-term current assets. That means short-term current assets minus current liabilities. You're looking at your short-term, not the long-term. Because long-term you have equity, which is a long-term form of capital, but in spite of having equity, you need to have short-term capital also to run the business. Right? That is because you have current liabilities which are recurring, and these current liabilities need to be settled. Right? For example, you have to pay your suppliers. it's a liability, current liability, and you have to pay your overheads, for your rent. All this has to be paid on time. So your operations need to run smoothly, which is why you need current assets, right, to run a smooth operation. Without current assets, you cannot run smoothly. You cannot operate smoothly. Right. So working capital is of a business which is used to its day-to-day trading operations. Net working capital is current assets minus current liabilities. Right. So remember, working capital is current assets minus your current liabilities. Current ratio, current assets over current liabilities indicates whether the company has enough short-term assets to cover short-term debt. Right. So current assets divided by current liabilities is your current ratio. This is something we discussed about 5 minutes back. So hopefully it is fresh in your memory. Remember, if the ratio is less than 1, it means you have negative working capital. That means you have negative working capital, means you have less current assets than current liabilities. If you are positive, or if the rule of thumb is a ratio between 1 and 2. If you are more than 2, it means you have a lot of assets idling in the form of current assets, which is not good for the bottom line. Right? So anything less than 1, the current ratio of current assets over current liabilities indicates whether a company has enough short-term assets to cover short-term debt. Remember, you might go bankrupt if you can't cover short-term debt. So it's very important that you have enough liquidity to cover short-term debt. Right? Anything below 1 indicates negative working capital. So if it's less than 1, it is negative working capital. Anything more than 2 means the company is not investing excess assets. If you're more than 2, that means you have twice the amount of current assets compared to current liabilities. That's not healthy either, because your current assets are inevitably invested in low return instruments like cash, treasury bills, which are very liquid and short term. Most believe that ratio between 1.2 and 2 is sufficient, right? So it has to be around 1 and 2. Not more, not too less. Working capital management is a managerial accounting strategy focusing on maintaining efficient levels of both components of working capital, current assets and current liabilities, in respect to each other, is known as working capital management, right? So maintaining the efficient or the just the right amount of working capital is called working capital management. Very, very important. As I said, right, working capital management is a specialized thing. Now, you and I can't just walk into a company and start managing the working capital. It requires a certain amount of expertise, a certain degree of expertise. Some companies might employ the most efficient staff to manage working capital, right? Because it's a crucial thing. It's part of your competitive advantage. How good are you managing your working capital? Because if you have surplus working capital, part of it might be useful to invest in other industries, in other avenues, right? That can increase the bottom line, right? So top line is there. You need to target the bottom line also. Bottom line growth is very important. So in between, you have to play. Right? This ensures a company has sufficient cash flows in order to meet short-term debt obligations and operating expenses. So efficient management of working capital means you're managing your current liabilities well, you're paying your dues on time, and also whatever the surplus you can invest and earn an additional return. Implementing an effective working capital management system is an excellent way for many companies to improve their earnings. Implementing an effective working capital management is an excellent way for many companies to improve their earnings. Which is why I said you need expertise to manage working capital, right? Now, you can't get a trainee who is just after school to come and work for a company to manage the inventory. Right? It's not just stores inventory management. Right? It's a science. Working capital management is a science. Right? It's also an art. Okay. Now, it's not about just issuing stocks from a store. You are not a storekeeper. Not just that. The science is you need to know from whom to order, when to order, how much to order, where to store this, and what is the most efficient process of issuing the inventory. When do you need to order the inventory? How long it takes to receive goods, and once goods are received, how long will it last? Are they perishable? How long can you use it? What is the useful economic life? And you also need to know when you're likely to get more orders, right? There might be, for example, seasonal effects. That means during a period like, let's say, New Year or Christmas, demand just spikes, no? Right? So your inventory levels will have to go up during such times. And now this level may not be sustainable long term. Right? So gradually you'll have to bring it down. So it's managing these levels which is crucial, can make or break a company. Right? Because if you have cost overruns, if your inventory is too high, your cost is running on at inefficient levels, you're not going to compete well. Right? You're going to be in deep trouble. Your competitors are just going to overtake. The two main aspects of working capital management are ratio analysis, which we covered, and management of individual components of working capital. Right. So this is one of the important concepts that we discussed earlier also. Working capital cycle, right? How long it takes to convert a purchase into cash. Now that is the objective now. Right? It's about purchasing a product, adding value, selling it, and then collecting the cash. It's a cycle, right? You buy products, sell, collect the cash. So it's a cycle, it continues. With the cash, you buy further products and continue to sell. Right? You buy on credit, you store it, then you sell it on credit, and you collect your cash. Right? Eventually, at some point, you pay your creditors also. That's called the cash conversion cycle, or the working capital cycle. Cash conversion cycle is a metric that expresses the length of time in days that it takes for a company to convert resource inputs into cash flows. Right? The time it takes for a company to convert resource inputs into cash flows. The cash conversion cycle attempts to measure the amount of time each net input of money is tied up in the production and sales process before it is converted into cash through sales to customers. Right, so it measures the amount of time each net input of money is tied up in production and sales process before it is converted into cash through sales to customers. So remember, cash conversion cycle measures the length of time, right? It is a measurement of time. Longer the time, why it's important is the longer time, the higher the cost. Simple as that. So cash conversion cycle should be as short as possible. Shorter the cash conversion cycle, lower your cost. Right? So that's the simple thing that you need to know. Right, so it measures the amount of time each net input of money is tied up in the production and sales process before it is converted into cash through sales to customers. The cash conversion cycle is a combination of several activity ratios involving accounts receivable, accounts payable, and inventory turnover. Right, so you need to look at those three aspects: the amount of debtors, creditors, and the amount of stock. Right? It's based on these three pillars. The ratios indicate how efficiently management is using short-term assets and liabilities to generate cash. So how efficient are you in picking and choosing your short-term, balancing between short-term assets and liabilities to generate cash? To calculate cash conversion cycle, you need several items from financial statements. Right? These are the items that you need both from the P&L as well as balance sheet. Right? Revenue and cost of goods sold. Your revenues and the cost of goods sold from income statement. That means the sales figure, the top line figure, as well as cost of goods sold. So revenue minus cost of goods sold gives you the gross profit. Inventory at the beginning and end of the time period. Inventory levels at the beginning of the period and the end of the period. Accounts receivable at the beginning and at the end of the period. Accounts receivable, how much of debtors do you have at the beginning and then at the end? Accounts payable at the beginning and the end of the time period. And how much of accounts payable? Right, your creditors. Number of days in the period. Right, now we get into calculations. Days inventory outstanding addresses the question of how many days it takes to sell the entire inventory. Right. That means how long, if you purchase inventory, how long are you going to hold on to inventory? So if you are holding on to inventory for excuse me, if you're holding on to inventory for 10 days, that means every year you will have 36 orders of inventory coming in, right? So when you get each order, it stays in your inventory for 10 days and then it goes out. So likewise, you will have to order inventory 36 or 37 times for a year. That's 365 divided by the days inventory outstanding of 10 days. So days inventory outstanding addresses the question of how many days it takes to sell the entire inventory. The smaller this number, the better. Remember, that's the most important thing. The smaller the number, the better. Right? So days inventory outstanding is average inventory divided by cost of goods sold per day. Days inventory outstanding, average inventory divided by cost of goods sold for a day. That's how we calculate. Days inventory outstanding is your average inventory levels, which is your opening inventory plus closing divided by 2 divided by the cost of goods sold for a day. Then days sales outstanding, right? How much of credit are you extending to your customers? This looks at the number of days needed to collect sales on and involves accounts receivable. While cash only sales have days sales outstanding of 0. So if you sell on cash basis, you are giving 0 credit. Right? Your credit period is 0. People do use credit extended by the company. So this number will be positive because your customers will always ask for credit. No, unless you're doing a cash basis business, your customers will have credit. They'll ask for credit lines, isn't it? Now, even if you're doing cash basis business, your customers might be buying on through credit cards, right? So that's effectively days sales outstanding, because instead of asking directly from the merchant, the retailer, to sell on credit, they're using a credit card, so they have up to 50 days of credit period to settle. They don't have to pay immediately, right? That's, in this case, the credit period, the burden of the credit period is borne by the bank, whereas the retailer gets the money on the same day, right? So that reduces the credit period for the retailer. He doesn't have to extend credit to anyone, and also it increases his turnover, right? That is why banks charge commissions from retailers, because on behalf of the retailer, they are bearing cost. Right? The credit period, the cost for the credit period is borne by the bank, but still the cost is incurred by the seller, the merchant. Okay. So while cash only sales have day sales outstanding of 0, so you buy on cash basis, right? You don't have debtors. The company doesn't have debtors. Day sales outstanding will be 0. People do not. People do use credit extended by the company. So this number usually is positive. Again, smaller the better. That means your collect. If the number is small, let's say 10 days against 100 days. 10 days means you're taking 10 days to collect money from debtors. If you're taking 100 days, that means you're taking a longer period. You have extended longer credit. So days sales outstanding, average accounts receivable. That means account receivable at the beginning and account receivable at the end divided by 2 divided by the revenue per day. Right? So that's the annual revenue divided by 365 per day revenue. Then days payable outstanding. Now when you purchase on credit, what is the credit period that you receive from your supplier? Days payable outstanding. This involves the company's payment for its own bills or accounts payable. Right now, if a company has purchased on credit, how many days does the company take to settle creditors? If this can be maximized, the company holds on to cash longer, maximizing its investment potential. Therefore, a longer days payable outstanding is better. Right. So remember, when it comes to days inventory outstanding and days sales outstanding, the shorter the better because you're collecting cash faster. But when it comes to days payable, that means the credit period that you receive from your supplier is longer, and that has to be as long as possible. Now, for example, the best way to think about it is if you look at your salary, right? How often do you want your salary? You want your salary every year. If you want, do you want an annual salary? Or what do you prefer? If your salary is paid annually, or every 6 months, or quarterly, monthly, how do you prefer to have your salary? Or do you prefer to have it daily? The shorter the period, the better, right? When it comes to inflows, but outflows, like your credit card outstanding. Do you want a credit period of what? What is the ideal credit period? Do you want a credit period of 1 day? You buy today, you have to settle tomorrow. Or do you want a credit period of 1 month, 2 months, 50 days? Or is it a quarter, 100 days, or 1 year? Longer the better, isn't it? Buy now, pay later. Longer the better, right? So when it comes to collections, should be as short as possible. Payments as long or dispersed out as possible, right? That's ideally how it works. So days payable outstanding, average accounts payable divided by cost of goods sold per day. Yeah. So remember, days sales outstanding and days payable outstanding are both based on cost of goods sold per day, right? Yeah. So days payable outstanding and days inventory outstanding are both based on cost of goods sold per day, whereas days sales outstanding is based on the revenue per day. That's why it differs. Yeah, it's easy to remember because days inventory outstanding, inventory is part of cost of goods sold, right? And days payable outstanding, that means how much of accounts payable or creditors you have is based on the amount of purchases, which is also a function of the cost of goods sold, right? Whereas days sales outstanding, debtors are a function of sales revenue. Okay, so it's easy to remember. Cost of goods sold per day. That means you take the total goods sold for the year divided by 365. Right. Okay. Can you all try and work out the three ratios based on these figures? What is days sales outstanding, days inventory outstanding, and days payable outstanding based on these figures? Take a minute and calculate. Right. So let's first do days inventory outstanding first. Remember, it's average inventory divided by cost of goods sold per day. These equations, you all need to remember the equations, and that's the bad news. Will get tested at the exam. Right. So average inventory, opening inventory plus closing inventory divided by 2. Cost of goods sold per day is the cost of goods sold for the year divided by 365. Yeah. Right. Take 2 minutes and calculate. Days inventory outstanding. How much do you get? I will also work it out. Right, so this inventory outstanding is your average inventory. Your opening inventory is 1750, closing inventory 2250. You get 4000 divided by 2, you end up with 2000. That is your average inventory divided by cost of goods sold, 8000 per day. Right, so you divide by 365. 91 days. Your days inventory outstanding should be 91 days. Remember, you get the outstandings in days. Right. That's days inventory outstanding. The next one is days sales outstanding. Okay, let's work that one out. It's average accounts receivable divided by the revenue per day. So accounts receivable 657534. Let's assume that is the average for the year. Divided by revenue per day is 10 million divided by 365. You get 24. So days inventory outstanding is 91. Days sales outstanding is 24. Then days payable outstanding. Average payable divided by cost of goods sold per day. 657534 divided by cost of goods sold per day is 8 million. 30. Okay. So those are the three answers you should get. Now the cash conversion cycle is days sales outstanding plus days inventory outstanding plus days sales outstanding minus days payable outstanding. Right. So your days inventory outstanding was 91 plus days sales outstanding was 24 minus days payable outstanding was 30. You end up with a cash conversion cycle of 85. Right. I hope all of you got it. I hope all of you are on the same page. your days payable outstanding based on these figures will come to 85, right? Okay. Right, so no questions. Let's move on. Cash conversion cycle, you need to calculate days inventory outstanding plus days sales outstanding minus days payable outstanding. Right? So we got an answer of 85. Fantastic answer. Beautiful. 85 days. Remember, it's in days. Right. Now, how do you interpret this? That is a challenge. How do you interpret 85? So how do you interpret each of these items? That is what you need to know. That is the difference between, that's what differentiates between that, sorry, what am I saying? That's what differentiates between the men and the boys. That's what separates the men from the boys. Right? The boys will calculate the numbers, but the men will interpret. So how do you interpret this? How do you interpret each of the items? Days inventory outstanding of 85. What does it mean? It means, on average, an item of stock will remain in your inventory for how many days? 85 days, right? You're holding on to stock for 85 days. So each item that you purchased will remain in your inventory for 85 days. So what is your inventory turnover? How do you calculate the inventory turnover? An item remains for 85 days now. That means whatever you buy is there for 85 days, right? So on average, 365 divided by 85. Every year, you're turning over your inventory 4.3 times. Your inventory turnover is 4.3 times. That's what it means, right? That means you're making purchases 4.3 times every year, or 4 to 5 times every year. That is what it means. The number of purchases for a year. Then days sales outstanding. What does it mean? You got an answer of 25. It means the number of days, a credit sale that you made will take to convert into cash. That means you're extending, in other words, 25 days of credit to your customers. Right? So your customers can buy today, they will pay in 25 days. That is what it means. Your days sales outstanding. The number of days the customers will take to settle. Then days payable outstanding. Right? You take 30 days to settle your creditors. Your creditors are giving you 30 days of credit. Your credit period is 30 days. Right? That is simply what it means. Now this cash conversion cycle is 85. That means an item which is purchased on credit takes 85 days to become cash. 85 days. Right? Your strategy should be, that means, in other words, you're out of cash for 85 days. Out of cash for 85 days. Now, out of cash, if you're out of cash, that means you're short on current assets. You might have borrowing requirements for 85 days. So if you have an 85-day borrowing requirement, you have to negotiate with your lenders. Right? You have to negotiate for a credit period of 85 days or beyond. Right? Because you're dead sure your cash conversion cycle is 85, so you need at least 85 days of facilities from your banks. Right? So go for 85 days or longer. Or the other option is to go for short-term loans, maybe even monthly, with monthly rollover. Right? So you need to have 85 days of borrowing lines in place. Without that, you are in deep trouble. Right? So that's the interpretation. Now, as DBF students, this is the most important thing. You're no more ACBF, you're in DABF. So it's very important that you know how to interpret. That is the value addition. That is the amount of thinking that should come in. Right? These are simple things. Okay. So I hope that was understood. Let me see if there are questions. No questions, so we can move on. Right, working capital trade-off. Working capital trade-off means no, it's always a trade-off. No? You have to compromise somewhere, right? Now go back to this. Days inventory outstanding, right? That means you got 85 days of inventory outstanding, the previous example, which means you're holding on to inventory for 85 days on average, right? Now, if you're holding on to inventory for 85 days, ideally your strategy should be to reduce it, not to increase it now, but to reduce, right? Okay, so if you're holding on, let's say for low number of days, what does it mean? Your cost is coming down, okay, but is there a possibility of running out of stocks? If that is a possibility, then you might have dissatisfied customers. Your customers are not going to be happy with you, no? Like your wife not being happy with you, right? How do you satisfy your customer? Remember, your customer is your wife, right? You have to satisfy. Otherwise, we'll go with someone else. And same thing goes for the customer also. If you don't satisfy, going with the competitor. Right. So how do you satisfy the customer? One thing is you need to, the benefit of satisfying customers is you build brand loyalty. Brand loyalty. Now that's very important. You have to have customers who are loyal to the brand. So they don't move out of the brand. No? They are always with you. You have a captive base. You have ring fenced your customers. Now, for example, people who drive Mercedes may not use any other car, right? Nothing else, only Mercedes. And likewise, there are customers who stick with banks. They don't move out of the bank. They're loyal to the bank. Now, what happens if Mercedes-Benz all of a sudden stops manufacturing cars? They say they are out of stock. We had Corona, no more Mercedes-Benz cars for another 3 months. You go and buy something else, you go and rent it out. Your customer will never come back to you, right? So it's important that you satisfy your customer. So you need to have always enough stocks to satisfy the customer. Things like that, right? That's why you need to, there is always a trade-off. So in terms of inventory, having high levels of inventory will lead to satisfied customers. You're never short of inventory, right? You go to a supermarket every day, you find that it has run out of sugar. You're not going to go back to that supermarket, right? You will go to some other supermarket. And there is a jungle of supermarkets now, no? So you're spoiled for choice, aren't you? Can go to any place you want, right? Right. So if you have adequate levels of inventory, your customers are always happy. No, you're never out of stock. Your customer comes to you, you know you have stocks, you're confident you have stocks, you can give exactly what he needs. Right? And the customer is also happy. He knows, top of the mind recall, you remember, right? If you think about sugar, he knows that it is available at Food City, always, something like that. Right? So he doesn't have to go to any other supermarket. Customer is happy. Few production delays, because you always have the inventory that you want. So no delays at all. Delays are things of the past. You don't have delays. On time delivery. Nothing to worry for your customer. It is guaranteed that you will deliver on time. Then it also helps the customers to make plans. Right? They also need to make plans. So it's useful. The downside of having high inventories, it can be expensive, right? As we discussed earlier, maintaining inventories requires a lot of cost, because you need to have adequate storage, maybe air conditioning, lighting, enough security, people to manage the inventory. All that is a big headache, right? So it's expensive, costly affair. The risk of obsolescence, right? You might have perishable goods. Maybe you have seafood, for example. You store seafood, you can't have it for years and years now. But of course, in Sri Lanka, they say that fish usually survive longer in fridges than in the ocean, right? So that's perishable goods, not a problem in Sri Lanka, right? We have adapted to these conditions, extreme conditions. We no longer demand for fresh food, right? So obsolescence never a problem in Sri Lanka. But seriously, inventory needs to be managed, maintained for long periods. If you're managing inventory for long periods, you need to be aware and mindful of obsolescence. Now, not only in the case of perishable foods, but what about things like technology? Say you're operating a mobile phone company. You're selling mobile phones. You're buying and selling mobile phones. Now, what happens if you buy? Let's say you're dealing only Apple, right? iPhones. You have a stack. You stack yourself with all the iPhones, right? The brand new iPhones you have. What happens next year? The inventory that you have is no longer in demand. Why? There is a new version that has come. So everyone wants that. So whatever you have in your inventory is obsolete. No demand for it. Then what happens? You're in a fix. You're in a mess. Yeah. So that can also happen. So remember, even technology these days might make things obsolete. Right? So technological obsolescence, huge risk. This was not really the case some time back. And Kodak, Nokia was happy. Okay. Right. So having low levels of inventory, the cost is you might run into shortages. Right? If you don't have inventory now, just imagine what will happen to Toyota if one of their suppliers gets into a mess. They are unable to deliver on time. Toyota is in big trouble. There might be shortages. Then your customers will be dissatisfied, like your wife being dissatisfied. Your customers will be dissatisfied. But the benefit, storage cost is going to be low. You don't have to incur massive cost for storage because you have only limited amount of stocks, limited amount of expenses. It's also easier to manage. Risk of obsolescence is less, far less than having high amounts of cash. Now, think of yourselves. Right? Let's say your net worth is 100 million. You're 100 million worth assets. Now, these assets, how would you like it to have? 100 million, you want all your assets to be in cash form? Right? What is the downside of that? You have all assets in your pockets in cash, nothing else. Right? So the money in your pocket is not going to earn you a cent, no interest, zero interest. So your return is going to be less. Right? So you have lots of cash. It means your return will be low. Profit will reduce. Right. So the benefit is you will never run out of cash. Right? You want to buy something, you always have the cash. You have cash ready, available at any time. But the downside, your return is going to be less. And maybe the 100 million was borrowed, not your own money, borrowed money, and you just have it in your pockets, you're going to lose out. Right? Because you're going to pay funding cost. Then having too low levels of cash will reduce your funding cost. Yes, you don't have to pay interest. You don't have less opportunity cost. Your opportunity cost is also less, but it increases risk. Risk is high because you don't have cash when you want. So your liquidity is low. You're thin on liquidity. Accounts receivable. Right? That means you're selling on credit. Longer credit you give, the happier the customer. Now, take your case for example. If let's say your credit card is having 50 days credit, then what if there is another credit card which offers you 1 year credit? Which one will you prefer? Longer the credit, the better, no? Right? So you go for longer credit periods, right? So you're happy with longer credit. That means likewise, if your customers, you're extending a longer credit period, they'll be happy. And your sales volume will also increase. But the cost will also increase. Why? You're going to be short of money, which you will have to borrow from somewhere. Right? You have to borrow it. So your financing cost will increase. Your administration cost will increase. You have to run after your customers to get the collections. Right? It can be, there is a lot of opportunity cost in extending credit periods. Right? Then your sales will also increase because you're extending credit, your customers are happy, they come to you always. If your credit period is low, your customers will be dissatisfied and your low sales volumes will drop. But you're collecting cash faster, so you can reinvest sooner. Then accounts payable and accruals. That means how long are you taking to settle your creditors? If you buy on credit, let's say you buy on 1 month credit, you pay your supplier in 1 month. But then you strike a deal with your supplier to extend the credit period to 3 months from 1 month. Right? Now your supplier is going to be short of funds for 3 months. So your supply is going to compromise somewhere. Hopefully the compromise will not come in terms of quality, because that's going to be a disaster. So it has to come in a mutually agreed manner. Right? If the supply is going to compromise on the credit period, is going to extend the credit period, you have to maybe give a commitment about a certain amount of purchasing. Okay. And the supplier might not be agreeable. Right? He'll say, no way. Reduces the need for external financing. Right? Because if you're extending your credit period, you're not short of cash. No, you have enough cash because your credit period is long enough. You don't have to pay until that time. So you don't have a cash requirement until then. Right? But your supplier might not be happy. It's important to keep the supplier also happy. Right? The supplier is like the neighbor's wife. No? So your wife as well as your neighbor's wife both have to be happy. Right? It's like that. So you have to balance everything. Supply is also unhappy. Now, the other thing is, it also depends on the supplier's bargaining power. If you all can remember a model called Porter's five forces: bargaining power of suppliers, bargaining power of customers, threat of substitute, threat of new entrants, existing competition. So all those factors also contribute in this case. You can't look at things in silos. Right. So if you have low levels of credit, your supplier will be happy. Right. but your financing cost is going to go up because you need cash faster than before. Okay, then profitability and working capital. Because high amounts of working capital means low profits. Working capital, as we discussed, is current assets minus current liabilities. You have positive working capital, you have excess current assets which are low yielding. So low yielding current assets will result in lower profits, right? But the risk is also less. You are not incurring a lot of risk, but your profitability will suffer. So if your current assets are high, risk is low, profitability low. Low risk, low return. High risk, high return if your current assets levels are low. Now, how do you fund your working capital? Right, you can have 3 different strategies, which can be moderate, aggressive, or conservative. Right, aggressive and conservative. These are the 2 extremes. Aggressive means you have low working capital. Conservative, you have more working capital. So aggressive means you use short-term financing to fund fixed assets. Right. Aggressive, if you're aggressive with working capital management, you're always depending on short-term funding. Right. You don't borrow long-term. So if your working capital amount is managed with short-term funding, you're aggressive. Conservative, you're using your long-term funds to manage your working capital. And use long-term equity capital for fixed assets and current assets if you're conservative. Moderate is you strike somewhere in between, right? Strike a balance in between. Yeah. Moderate is where you match the maturity of assets with maturity of financing. So you try and strike somewhere in between. Let's say your financing needs are for 3 months, then you go for a 3-month loan. Now, if it was 3 months, you are aggressive, you'll go for 3-month financing requirement with 1 month borrowing, right? So you're depending on your bargaining power in that case. That means you feel your lender will be willing to lend 1 month from today. He'll be willing to roll it over. If he doesn't roll over, you're in big trouble. Right? So that's the risk. But if you're conservative, then you take a 1-month facility from a bank and gradually manage your working capital. Right? So all 3 strategies are good. It depends on your risk appetite. So moderate financing policies. Now this gives the amount of working capital requirement against the time period. How are you funding your working capital? Right? You will have your fixed assets. Then on top of that, you will have your permanent working capital requirements. And then your temporary needs will also be there. So how are you funding it? How are you funding the working capital? Right? Temporary net operating working capital and the permanent working capital. So fixed assets usually get funded by long-term investments, long-term financing, maybe through debt or equity, debentures, equity. Right? So up to a certain level, you will have the long-term financing. So if you're conservative, your short-term loans will be less. You're funding the bulk of your requirements through long-term sources. That is if you're conservative or moderate. Right? So the longer the short-term component, the more aggressive you will be. Right? So this is conservative. All your funding requirements are catered through long-term facilities. Nothing is short-term. You don't believe in short-term, then you're conservative. See, all your assets funded with long-term borrowing. Right, so the advantages short-term versus long-term debt. Well, we are running out of time also, so well, long-term usually, advantages of short-term versus long-term debt. Short-term is usually low cost. Right? If you borrow for 1 month, your cost is likely to be less than borrowing for 1 year. It's easier to negotiate also. Right? Banks will be willing to lend short term than for long term. That's why banks are very aggressive when it comes to giving credit cards, but they take months and months, several moons when it comes to housing loans. Right? They are easy to get if it's short term. Short-term loans you might be able to repay without a penalty. Credit cards you don't have to wait for 50 days to pay. No, you can pay in advance. But if you settle housing loan in advance, you might have prepayment penalties. Disadvantages of short-term versus long-term. Short-term, you believe that the bank will be willing to refinance. Right? If they say they pull the plug on you, then you're in trouble. Higher risk because the required repayment comes quicker and the company may have trouble rolling over loans. Right, so that's it for today. We are out of time. If you have any questions, I can take. I can give you 1 more minute. Couple of minutes for questions. If you have questions, you can ask. Or else, if there are no questions, we can wrap up for today, right? So I think the slides will be shared by the Institute during the course of today. Okay, you all received the slides. Very good. So hopefully it was uploaded onto the classroom. Thank you very much then. I'll see you all next week. Have a safe week.